On to our next guest then, and we're putting the spotlight on IKS Health. We have Nithya Balasubramanian, whole-time director and CFO at IKS Health, joining in to take a couple of questions. And of course, we want to get some clarity on three key focal areas: the company's growth and expansion strategy for 2026, the partnership with the Google Cloud, and update on the integration and cross-selling to Acuity customers. Acuity is a company that they had acquired a few years ago. Nithya, good morning. Great to have you in. Thanks very much for joining in. So I'm going to start with the most interesting part of it all, and that is AI, right? And it seems that you folks are integrating agentic AI with your operations as well with this Google partnership. Tell us more. It's an exciting time. But in terms of, real operations, what it brings to the table, the costs of, doing this agentic AI integration vis-a-vis the returns, what are we looking at over the next couple of quarters?
Hi, good morning. So AI and investments in technology happens to be the most strategic vector for IKS. I think we have been very consistent in talking about this in our earnings calls as well. In fact, if you look at our technology spend, it's inched up quite significantly, now touching about 5% of revenues. And I actually foresee this continuing to grow meaningfully as well. If you look at our AI investments, there are multiple use cases some of them are live and some of them are, of course, still in the lab. I'll talk about a few that we are most excited about. In autonomous coding, for instance, there are two use cases in two specialties that are already live, and we are now trying to expand that to other specialties as well. In terms of prior authorization, or what we call patient financial clearance, where you need certain permissions from the insurer before you can even see a doctor or be prescribed a certain treatment. Again, we have pushed several AI use cases and achieved very high levels of automation. And the last but not the least is the agentic AI platform that we have launched on Google Cloud, which is actually able to connect automated workflows across tasks. The reason this is unique and important is because when you're able to connect these workflows, your ability to maximize for what the customer wants, which is to be able to get the right revenue for the right care that's delivered and to minimize costs, is much higher than if you're addressing individual tasks.
Sure.
So yes, we're very excited about this.
Sure. So you said that your current spends on technology are at about 5%. And they're likely to go higher. Give us some sense of, how that scale up is going to be and how that starts and by when it starts feeding into margin. I mean, you did really well on margins even in the quarter gone by. You're at about, 31% ballpark now. So as some of these AI efforts mature, how is the margin profile going to improve? I mean, we're just trying to understand cost benefit analysis here. Some projections will help.
So I won't be able to give you future projections, but what I can tell you is what we have delivered in the past, right? So if you go back and look at legacy IKS financials, you'll realize that from the FY20 through FY24 timeframe, when my revenues grew 25% CAGR, my employee cost in the same timeframe grew only 8%. And the non-linearity is entirely due to the technology investments and the automation that we were able to deploy in the various features. So with AI, of course, we're hoping to see similar kind of leverage, but that'll happen as we put these products out in the market.
And the tech spends go up by how much from the current 5%?
So it'll anyway grow right alongside revenue. I don't see this percentage of revenue coming down. We might even step it up depending on some of the new features, etc., that we're working on the platform.
Okay. So let's talk about, how the overall business is shaping up. We had a brokerage report out a couple of days back on the company, and that note sounds very, very optimistic. I mean, just to quote, this is Nomura. Nomura is saying that at a CAGR level, you can probably do 16% revenue and a 32% EPS CAGR going up to FY28. Do these sound like, fair calculations and fair assumptions to you?
I really cannot speak to what is there in the analyst report, but I'll tell you what we are guiding the street, which is that, one, we do want to be able to grow several notches higher than the market growth itself. The outsourcing market growth in our space is expanding at about 12%. So yeah, several notches higher than that. And in terms of EBITDA margins, our guidance has been that the early to mid 30s level is what is sustainable for us. We're already touching those levels, and we're comfortable saying that in the near to midterm, we should be able to maintain these margins. When it comes to PAT or earnings growth, yes, it should grow faster than EBITDA, because we do see significant cash generation, and therefore our ability to get to zero net debt level in FY27 itself. So you'll see that impact in earnings.
And we'll ask you that one question that we always ask, but then, you can imagine why we ask it, because there's just so much of rhetoric coming out of the US almost on a daily basis, right? It's one day it's H-1B visas, the other day it's Indian rice. And I mean, you are heavily dependent on, of course, US customers. So all is well or anything, I mean, anything that you need to tweak or strategically change in terms of how you're servicing these customers as we enter the new year, given the current White House dispensation?
It is fair that a lot keeps happening and a lot makes the news as well. But I think so far, if you look at what specifics that they've talked about, so H-1B visas, for instance, has zero impact on us because that's not a business model. Whatever talent we need in the US, we actually hire in that geography. Right? So H-1B visas do not have an impact. I think at some point of time, they were talking about a potential act where they might increase tax for firms that are outsourcing.
Yes.
And again, that again did not see any support. So no impact. But broadly, I think what they're trying to do is reduce healthcare spends, right? If you look at the US, they're spending almost about 20% of GDP, and they really need to do something to bend the cost curve. So they have come up with measures to reduce Medicaid spending by quite a significant amount. Again, for us as a business model, our customers are not exposed to Medicaid. It's more Medicare and commercial payers. And therefore, that impact is rather insignificant. But that being said, given these broader headwinds, it's if anything, it's maybe a little easier for us to convince our customers that, hey, we are part of the solution. Here's one way for you to actually shore up your P&L in light of all the headwinds that are playing out.
Yeah. Nithya, morning, Prashant here. Sorry, I just very briefly, this entire AI bit, right, can it become like a competitor internally for you? It helps in efficiency, etc. But could it cut down per customer billing rate?
So I don't see that happening in the near to midterm. If you look at how we have always priced our product and services, it's always been based on the outcomes that we want to deliver to the customer.
But the customer on the other side, if they realize that you're getting a lot more done with a lot less, they're gonna want that, right? They're gonna want that savings across.
We're not having those conversations, Prashant, so far. I think while AI is the pace of change is quite healthy, we've always been deploying tech, right? You go back and look at my 18, 19-year history, we've always been deploying tech, whether it be machine learning, robotic process automation, and the model and the way that we actually deliver our services and the way we price our services, we have been able to take leverage of that.
Okay.
That tech deployment onto our P&L. Of course, it's very difficult to predict what will happen 5 years from now, 7 years from now. But I think in the near term, based on the conversations that we're having, for a large part, we should be able to take benefit of technology. In some cases, yes, I think it remains to be seen. Over a period of time, we'll see how this sector matures and shapes up. Maybe there are some parts of efficiencies of technology that we have to pass along. We're not there yet. But again, we're not shying away from that either.
Okay, got that. So evolving situation, but at this stage, at least, as we speak today, you're not foreseeing that happening in a big way in terms of per customer billing rates getting impacted because of all this deployment. Thank you very much for joining us, Nithya. Appreciate you coming on here on CNBC-TV18.